customers. So today the business mix looks like about 60% is related to municipal type of customer, and 40% or so is about industrial type of customers. And we apply the whole variety of solutions, whether it is water, wastewater, water reuse, desalination, processed water for industrial customers, recycling of water, and all that. And beyond the customer type of itself, what we're trying to do in H2O is gain and build this customer intimacy. That's really important because you have laid out, Mona, the sales cycles are long, right? The municipal world, I mean, it will take months/years to earn the first contract. But how can we build and gain more predictability? Is first, once we have this contract, let's make sure we do everything we can to retain it. And this is something we have been really good in the last couple of years in H2O, is maximize customer retention to keep our customers, but also gain financial predictability. So our business model today really promotes this customer retention. Now, as you move and get closer by not only providing equipment, because once you provide an equipment like we do, I mean, we design and manufacture this equipment, we are usually a sub of a general contractor. The end user is a municipal customer, but our customers, we make an invoice usually to a general contractor. The general contractor will invoice the city. Or there might be even, you know, a mechanical contractor, which you'll invoice the general contractor, which will invoice the city. So we're far away. So this is why through our business model in the last couple of years, we have tried to gain intimacy. So get this by providing chemicals, by providing consumables that you need once you operate a system like this, you get a little bit closer because you're selling to your own operator. But once you are the operator, as we are now, and we're operating 275 utilities across North America, we are in best have this intimacy with the end user, with the owner of the utility, because we are reporting every month on the compliance, on the regulation, on the maintaining of these assets. So this is why not only it's important to have the right business mix, but to build through the relationship, this intimacy, allowing us to gain predictability and have more and more recurring sales.
That's a really interesting point. And when you were talking about the intimacy of the relationship, do you feel that oftentimes when you're having these initial discussions with municipalities, they have this smaller X budget and they need it to cover, they're like, our budget versus the work that we have to do doesn't even cover, 5% or 10%, and you're more transitioning. Is that something that you're doing or could transition to as more of a consultant or aid for them as to, helping them with the allocation of funds and how to address their issues?
More and more, yes, more and more. But as you are at the first seat, right? If you are the operator, you will have this conversation. If I'm providing an equipment, most likely I will not have this conversation. So this is why this intimacy is really important. Now, you can articulate an offering and create an offering that will overcome these issues of financing. You can bring a third party to help you out with the financing. We have even in the past, and still today, self-finance some upgrades to our customer because of this intimacy, allowing us to gain even more predictability, extend even the operation and maintenance of our contracts. So, but the municipal world is also evolving. They're starting to welcome more and more the private sector to come in and help them out with their issues.
Okay, thank you for that.
It's an evolving situation. I mean, it's everything but fast in our world.
No, completely. And then just moving on into kind of the end market, macro factors or tailwinds that impact you. President Biden announced the US $2 trillion infrastructure spending plan, and we have an exhibit of that in the ENC backgrounder slide deck to the right on the virtual briefcase. But in Canada, there's heavy investments in the water sector within that 180 billion spend plan, which is a 12-year plan. What are other factors that investors could be watchful of besides these, broad-based budgets or cognizant of as lead indicators?
Well, I mean, there are so many things behind it. I mean, beyond the investment done by the government, I think, there is certainly The regulators. Regulators are not going to slow down or not going to relax any of their terms. So it's becoming a more and more stringent environment. And it's harder for small municipalities to cope with all these different regulations out there. Regularly, the ones that are poorly operated receive fines of thousands and thousands and thousands of dollars every day when they don't respect, their either discharge or things like that. So I think regulation is an important driver. I think the scarcity of water as well for industrial customer is also a concern. If you are Procter and Gamble, if you are Philip Morris, if you need water continuously coming to your plant to transform a product or to create a product, you must ensure continuity of supply, right? You cannot rely anymore on the city only saying, well, we ensure you the supply of water. So you have to become more independent. On top of that, tariffs are changing and evolving, and it's not going down, it's going up. So again, if you're Procter and Gamble within Los Angeles and you have this big factory, and suddenly the city of Los Angeles or Orange County is coming to you and say, well, you know what, your tariff on water is going up 5%, 16%. Suddenly you're screwed into your processes. So this is why industrial customers are becoming more and more independent and adopting water reuse to improve their processes and gain independency on these issues related to scarcity, price of water, because it's just a matter of time before we have a truly price of water, and the regulation aspect around it.
Okay, thank you. And if I'm just thinking about the growth of the water sector, I know that there are events that can, increase that growth in the near term, such as massive infrastructure spending plans. But is it fair to say that in, Canada, the US, growth is similar to GDP? So like 2-3%. I know that in emerging markets, just from my research in the coverage of the E&C sector, it's much higher. It's high single digits, even low double digits. So just getting your perspective on what you think is the overall end market growth in different geographies.
Well, within the geographies we're looking at, you're right, in Canada, it's a little bit slow, around 2% or so. But you see in the US right now, we're anticipating growth between 4 to 6%, depending on the industry we're going after. So your assumption is pretty good, And what we're trying to do is to beat that, obviously. We're trying to beat as H20 because we're still small, we're still nimble, and there's still a lot to be done. We're trying to beat, this kind of 4 or 6% to probably aim at 8 to 10% organic growth.
Okay, so within the overall market, there are pockets of higher growth areas that you are targeting.
Yes, let's say that the water reuse I was referring to. So water reuse is the fastest growing market right now. So it's growing faster than the water itself or the wastewater treatment.
Okay, no, helpful. And then just turning to your broad-based 3-year strategic plan, your objectives in that plan include digital evolution, expanding specialized products, acquisition, championing ESG, customer satisfaction, just to name a few. And so it is, when I'm reading through the slide deck and your materials and the presentation, it seems largely quantitative, but I'm just wondering on the translation of that qualitative side to the financial side of things. You did release financial estimates up to 2023, and at the top end of the range is a more than doubling of revenue. I'm just wondering what is driving this. Do you have acquisitions factored in there? Although the timing and size is hard to predict, but just for the baseline business, how should we think about that ramp, or investors think about that ramp?
Yes, well, on the revenue growth, definitely it will be supported by intensive acquisition plan to move it to the 250 million that we're referring to. We do have a lot of opportunities, a good pipeline of M&A deals right now. We have a universe of 30 companies that we're looking at as we speak. We're more active with 10, and we have targets on 4 of them, clear targets. So this is why we have laid out into our plan that we wanted to realize 2 to 4 acquisition within the next 3 years, bringing us to the 250. I think at this point, we're more looking for tuck-ins type of acquisition. So acquisition that will be in a range of $10 to $20 million a piece in terms of revenue. that could be complementary to what we're currently offering. Most likely around more specialty products and more operation and maintenance type of businesses. And as we evolve, I mean, bringing, 2 to 4, I think it will be more in the area of 4 acquisition because the way it looks right now. And this will bring the additional revenue that we need. I mean, if you combine the 8 to 10% organic growth I was mentioning, starting from the 145, 150 million we have now, you add this to 8 to 10%, then you add the acquisition, the 4 acquisition, let's say averaging about 15 million, let's say, you ended up with the 250 or so million I was referring to. And we have a solid balance sheet to conduct this. So it's not only wishful thinking, it's very strategic, it's very targeted, it's accessible. The tuck-ins acquisition, we intend to do it without dilution for the shareholders because we want to use our own balance sheet. You see right now we have our I would say our EV, I mean, the debt to Ebitda ratio is less than 1 time. So we have room to further leverage our balance sheet up to 2.5 times, let's say maximum 3 to leverage it a little bit. We have our own cash flow generated from the operations. We have also exercise of warrants that we did from a previous financing, warrants that are into the money at the $1.40. They are expiring in November 2021. So this will bring an additional $14 million in cash. So altogether, between the additional debt, the cash flow, and the cash coming from exercise of warrants, we have about $60 million worth of value and cash we could use to negotiate our acquisition.
Which is those 4 acquisitions, just doing the math, right? Yeah. Okay, perfect. No, that was helpful and a good composition of how that growth is going to, roll out in the next 3 years. And so I'm just thinking about the question. So I think I'm just going to go back and switch back to the M&A because you said that you had, kind of 4 serious targets, 30 companies kind of that you have identified within that pipeline. I'm just wondering if you could talk, even, you had recently made an acquisition in February this year. How do these acquisition discussions occur? Is it you targeting these companies? Is it companies calling you and saying, hey, we want to be, picked up? And then on a purchase price multiple basis, have you seen any shift in the last few years? What is a range that you guys are comfortable with? And even if you are paying, 4 or 5 times Ebitda or, 0.8 times sales, is there any accretion that you can get subsequently after you have integrated these acquisitions?
Yeah. Well, I mean, in terms of acquisition process, M&A process, we are usually knocking at the doors of the sellers. So it's rarely, I mean, it came more this way than it was truly, bankers, advertising for companies and then us participating to a tendering process. Usually the tendering process have the tendency, obviously, to inflate, the multiple paid for, which is the role and the purpose of the bankers for the benefit of the sellers. But we try to go and target these companies. You see, Genesis that we acquired back in 2019, I've been on their heels for 10 years almost. I met them first it was a competitor, but I met the owner first back in 2010 in London. Initiated the conversation. They were not ready at that time. And then several years later, they contacted us. And then we started the conversation again. It's a long process. So this is why we need to have this kind of pipeline of acquisition. Now, usually we have been very disciplined in the multiple that we paid for these companies. You see for specialty companies like chemicals and things like that, because of the high recurrency and high margins, we have been able to pay companies between 6.5 times to 9 times Ebitda. For companies in the operation and maintenance, still highly recurrent, but slightly lower in term margins, we have been paying between 5 and 6.7 times, 7.6 times, sorry. Now, the tendency that we're currently observing, though, lately is that probably what we were paying 5 times, we'll be paying 6 times. What we'll be paying 9 times, we'll be paying 10 times. There's an inflation of 1 to 2 times round of EBITDA. Let's put it this way.
Okay.
There's a lot of money in the market. Private equities are very thirsty for water as well, and they're going aggressive and they're paying high multiple. But this is why we want to remain disciplined, because usually in our transactions, all of them, we have aim at about 25 at the lowest to 40% accretion into our transactions. And we do them without a high number of dollars budgeted into the synergies. So I'm saying this because for us, we prefer to pay the right price instead of trying to pay a high multiple. Yes, we conclude the acquisition, but then we have so much to capture in terms of cost synergies that we have suddenly on day one tremendous pressure to remove cost.
Yeah.
Right? Because this is not healthy. I mean, what we want to do here is to do 2 things. Keep our employees as much as we can because they're valuable resources. And second, keep our customer. At the moment you start to have on day one this pressure to come up with cost synergies, you create an environment without psychological safety around you where people will start to leave the boat and customer will feel the impact and you will lose your customer. So having a good entry price is so important and strategic. And that's why I would prefer to remain disciplined and pass on and wait for it.
No, that's a very sound strategy. The amount of acquisitions I can tell you in my 13 years in equity research where they come out the gate saying we're going to get this much in synergies to make this multiple work. I mean, there is massive acquisition integration risk. There's culture issues. I have specific examples of water companies where the sales team walks out and then, it's a disaster. So I understand and appreciate your comments. And so now just switching back a little bit onto the financial performance, we had gone to your 3-year strategic plan, how that is built up, the composition of it. We touched on the acquisitions. I just want to understand a little bit on the margin side and the profitability side. I understand you're targeting EBITDA margins of 11%-ish plus by 2023. I'm just wondering how much more margin expansion do you think you can get? I mean, you talked about the different product categories and how the profitability varies. And is that going to come by you guys purchasing companies that have greater profitability, or is there other things such as, synergies, cross-selling, greater value add offering, increasing utilization, just on that? Thank you.
Well, I would say we're definitely moving in the right directions for the 3-year plan of 11% plus target. So that's first step. So we're really happy and confident to be able to hit on these objectives for the 3-year plan. We took a conservative approach to put forward these numbers because, it was the first time we were disclosing these numbers and we want to make sure that we have some breathing rooms also to make investment. Because as we're still small, I believe it's important to continue to be able to reinvest into our organization to further grow. Now, percentage of EBITDA to revenue is important. I mean, I think below 10%, we were into a zone where it was questionable. Now, if you're asking me, are we going to be 20%? No. Because we want to be able to reinvest. Are we going to grow the absolute dollars of EBITDA? Yes. And to do this, we need to reinvest into our sales structure, more salespeople, more development of products and things like that. So is the sweet spot between 11 and 13%, and be able year after year to continue to reinvest and fuel growth and fuel opportunities for business development and new product innovation. I think this is where we're aiming at.
Okay, that's very helpful. And are customers price sensitive at all? Is there pressure? That's at all. Your response said it all. You didn't need to say anything.
it's taxpayer money. Yeah. Well, the
Yeah.
thing is that it is very price sensitive. And this is why, to go back to my initial comments about this intimacy, is so important. So we're trying to, quote unquote, walk away from the general public tender bids because, unfortunately, I mean, sometimes they're only driven by money. We're trying to educate our customers and the consultant, and more they are adopting also best practices to not only look at the bottom line, but they will be making life cycle cost analysis. They'll be looking at qualitative things also, aside from the price only. Because every time we're choosing and accepting as taxpayer, you and me and all the other ones, to select the lowest bidder, it's a collective suicide. What this infrastructure will look like in 15 years, in 20 years. So we have to walk out of this process and accept that you're looking for value-added solutions. And this is why H2O, within what we're offering, we have more and more to offer. We're trying to diversify ourselves and differentiate ourselves with the different technologies we have. But it's a process, but it is still very price sensitive.
Okay, no, I had to ask, just see your reaction. Okay. Just more a soft one, what words would you use to characterize the state of business currently? I know you just got off a call with Madrid and you were very excited before we started this call.
I'm realizing my dream of 20 years ago.
Yeah.
You know, it's 20 years ago, I wanted to do that. I wanted to build the international organization that we are becoming. I wanted to make a difference. And this is currently happening. And for me, it's the beginning of a new era where I think we'll be growing tremendously in the coming years through acquisition and organic growth. I couldn't be more proud of the team, of the company, of our performance. Yeah.
I know that it's just nice to hear your insight. I want to talk about COVID a little bit. The last year has been extremely challenging, surprises, some positive, some not so positive. I'm just wondering, from this point, I know Canada's, 75% of Canadians are expected to be vaccinated by the end of September. I know that everyone's still in work from home mode. Schools are shut down once again. What can investors expect just going forward in regard to any impacts related to COVID and the business positioning overall? Has that changed? Has it slowed anything down at all operationally, within the team, anything?
I mean, I thought water was a good industry to be in. It's the best industry to be in. I mean, people are still drinking water despite COVID. They're still flushing their toilets. We haven't heard anyone that have shut down a wastewater plant or shut down a drinking water plant due to COVID. So we have continued to enjoy solid business. We have continued to grow our business. Right now, we're even seeing numbers that are just unbelievable from China. They're now back into growth again. Almost double-digit GPD they're aiming at, or high single-digit. It's the best industry to be in. Now, not only I think we have the right industry to be in because water is essential. Water is part of the essential services. And it is a resilient business, but our business model now, because it relies on high recurring sales, we have like 90% of our revenues that are recurring by nature between the chemicals, consumables, the operation and maintenance, and the service contracts we have. So our business in itself is highly recurrent and predictable. So yes, Mona had some concerns when this crisis began back in March. Now it's a little bit more than a year ago, last year. We took conservative approach. We were very conservative into our assumptions when we had developed our budgets. Into the raise we gave to employees. Our preoccupation was more, instead of giving important raise, was more like, let's keep our employees, right? Let's do everything we can to keep everyone engaged and employed.
Yeah.
And then as we move in time, the uncertainties lifted up, and then we started to give more raise and give back to the employees. That was our approach, because it was, now it's easy to talk about it because now we're into a year into it. But there was uncertainties, and now we have proved, I think, that our business model is solid and that we are in the right team.
Okay, thank you for that. And interestingly, China had positive growth, GDP growth last year, despite everyone, having, so, yeah, and we're already seeing it in regard to the 2021 forward numbers. So I just want to, I don't know if there's any audience questions. Julian, do you have anything? I have more questions, but I just wanted to see if there was anything from the audience. As
Nothing
I said,
from the audience.
Nothing from the audience as of yet. So guys, don't be shy. It's a very exciting conversation, I know, and we'd love to hear any questions that you do have. But we'll just continue on. So ESG, it's picking up pace rapidly. Majority, over 90% of Canadian fund managers factor in ESG criteria into their investment decisions. Now, the core business that you have is quite attractive from an ESG perspective, right? You're doing water. I know for smaller companies, it's been challenging. There's a lot of resources that need to go into putting out these sustainability reports and generating all of this information to, illustrate where you stand. But I just thought I'd give you the floor a little bit to talk about different, your ESG strategy and different, points that you wanted to raise in this regard.
Well, I mean, you said it right. I mean, there's a lot to be done. I mean, just to identify the framework that we will be using and referring to moving forward. Our game plan is to come up at our next annual meeting of shareholders, which will be in November this year, to come up with our first ESG report on which we're going to identify the targets, on which we're going to identify the things we want to benchmark with. But overall, I can tell you that the priorities of our plan will be most likely around team engagement and safety. We want to make sure that our team, because we are more or less an important organization with 700 employees that relies a lot on HR to perform work. Because we are providing the labor, we are operating plants, we have more than 400 operators across the United States and Canada. So we need to have really good engagement to first keep our people. Second, make sure that they're safe, because with more and more and best practices, health and safety, we're going to improve our best practices. We're going to reduce our TRR. We're going to reduce, the level of accident and the cost associated to insurance as well. But also we want to make sure that they feel achieved and motivated. So we're going to do things a lot around HR. We're going to do things also around, how can we come up with best practices around, protection of the environment. I mean, it's not because we're into water that we shouldn't be doing the right thing also. Within H2O, we have one of our division, PWT making chemicals. We make these chemicals for the antiscalants. It's without phosphate. So this phosphate-free chemicals is really green in itself. So how can we make better use of these chemicals for our customers? Because we're making phosphate and we're making our phosphate-free chemicals and we're making our own polymer in California, we can make a product which is super concentrated, 11 times the concentration. So it means what? For example, it means that we're exporting this product 11 times the concentration with less water into it. So the cost of freight, implicitly the emissions that comes with, the cost of freighting, the cost of storage, the cost for the customer is slower. So they have an interest of using more and more of this green chemistry, for example. So we're going to put more emphasis into this. We're going to see how we can reduce ultimately the emissions also for the consumption used by the cars. We have a lot of vehicles within H2O. Obviously, as we're growing, but because of the number of sites and operators we have, the second largest expenses after labor as a single expense for the operation and maintenance is gas. Unbelievable. So how can we maybe change progressively our fleet? How we can change our practices to come up with alternatives to oil and reduce emissions? So a lot of excitement, a lot of things to be endorsed by the board, a lot of things to come up with. stay tuned for the annual meeting of shareholders in November.
Thank you for that. And I do think we got some questions via email. I am not able to access Nishita just because I'm on this. Nishita, I don't know if you are on the line and Julian wanted to open
yeah, I actually have a question from from Nick Callback.
Okay.
So Nick says, H2O's presentations show how broad their footprint is across the US. So his first question is whether or not H2O Innovation is focusing on any specific geographic regions within the US. We have seen the droughts and strains on the water system in different municipalities of the states of California. So are there other troubled states or jurisdictions that H2O views as, let's say, high opportunity?
Yeah, it's a good question. I mean, we have indeed, quite large footprint. We have about 800 systems installed across North America. That makes us, second in terms of reference of install base. Without necessarily focusing on specific geographies, because we're pretty well spread out, I will say that all the areas within the Chesapeake Bay area, which is the eastern United States, is an area where there's a lot of concerns around water, of the quality of the water. So there's even new compounds now that have been found into the ground. So they're looking for ways to remove it. So this will be certainly in the coming years an area of interest for water and for wastewater. All the area of Texas remain an area where we have been growing. We went within 5 years from having mostly nothing in revenues to now we have steady $25 to $30 million a year of revenues around Texas. So it is still a growing state for us with a lot of opportunities. Now, within all these different markets, geographical market, what we're trying to do mostly is to go into the small mid-sized area market. So I would say all the municipalities that serve less than 200,000 population is more or less the sweet spot we're going after. So beyond the geography itself, we'll try to focus within a specific niche market also. And it's the same for Canada. It's just that it's 10 times smaller in terms of population and market size. But it's the same dynamic of environment.
Okay, thank you very much for the insight, Frédéric. Nick had a second question. So the First Nations have been lacking potable water for years, particularly on reserves across the US. With federal and even more specifically, tribal budgets, does H2O work with these specific communities, and can this be identified as an area of growth for the company?
Yes, and yes. Yes, we have worked previously with First Nations. I would say we have in Canada done about 30 First Nations communities between Alberta, Manitoba, Northern Quebec. So it is still a priority, and there's more coming, obviously. And in the US as well, it's the same. We're currently even operating on one First Nations in New Mexico. It's called Dolce. So yes, it's a big market. It's a market that is struggling also with proper training. The challenge for the First Nation is that once you have these equipment installed, even though they can work remotely because of telemetry and communication and all that, it's a matter of having properly trained operators that will stay within the First Nation. So the challenge will be in the coming years how we can develop an approach where we could ultimately team up with First Nations communities to have circuit riders and training provided to the operators for a group of communities. So this is what we're aiming at, but it is certainly an area of focus that we have within H2O.
Okay, thank you, Frédéric. I don't see any more questions from the audience. So Mona.
Perfect. We're coming up on our 45-minute time slot, but I wanted to thank you so much for your time. It was a passionate discussion, I would say, on your part. It was insightful and extremely interesting. So in 20 years' time, are we still going to be here? We're going to continue the conversation with you as CEO?
Absolutely. I hope so. Absolutely. I always said when I started the company, I'm going to bring it to $1 billion.
Okay.
So as I told you, I'm living the dream as a CEO, but believe me, I have a lot of thoughts and a lot of ideas to keep growing it. So.
Okay, everyone in the audience hear that? 1 billion.
This is not guidance. It's just a dream.
Thank you so much for your time. It's been a pleasure, and have a lovely rest of the day.
You too, and thanks for the opportunity.
Thank you. Everyone, we have Euro DevTech coming up next at 10 a.m. So stay tuned. Thank you.
Thank you.
Hi guys, am I off?
Yes, video's off.
Okay. And no one can hear me, right?
No, no.
Okay, I'll just mute it just in case. Thank you guys.